How
we doing today, folks? Everybody doing all right? I'm going to take a moment and let the tax track students just take a big deep breath and exhale a little bit. I understand that this morning was full of fraught and full of peril. So if you have a tax track student near you and you want to take a moment to just kind of commiserate with them and just say, okay, it's going to be all right. Everything's going to be okay. Yeah. All right. So for that, I just wanted to make it known that I do care about both tracks. Okay, I do have sympathy for both tracks. And so, well, I mean, I'm not going to say I don't have preferences, but yeah, but a sympathy exists in both directions. You know, so yeah. So today we are going to talk about our final part of fraud prevention and deterrence. Just as a reminder, we're starting investigations next week, and that's actually going to include an investigation that will take part as part of groups. I do want to make a note that I made a comment on that Matt and Kirsten were going to be helping me out with this investigation for the next few weeks. I did not assign them to groups as part of the questions, but I did assign because they were going to be helping out with the investigation, but they are still going to be answering questions with the groups. So just so you know, week 1 will be group 1 and group 4 respectively. Week 2 will be group 2 and group 5 respectively, and week 3 will be groups 3 and group 6 respectively. So if you see Matt and Kirsten joining your group for questions, that's the explanation, is that they still need to be part of the question and answer sessions, but they're going to be helping me out with the actual investigation. And just a reminder for the investigation, please make sure you read the case before you come into class. If I'm coming to class and people are preparing for the investigation part by reading the investigation, I'm going to be a little bit disappointed. Okay, a little bit disappointed, and you won't be able to use the excuse that you had a tax exam earlier that morning, because I know that's not true. Okay, although I guess it's not. That could be true for some people, because you could have had Dr. Deers. Although it's in her class on Monday, Wednesday, Friday. So yeah, no excuses. No excuses. Sorry. Yeah, throw that out. All right, today we're going to be talking about corporate governance, management responsibilities, and fittingly enough, when we're talking about the tax students' responsibilities, we're going to talk about audit responsibilities. This is basically not an inclusion that I did deliberately. This is actually part of the fraud examiner's manual, and I think it's important to talk a little bit about it, simply because it will be a relevant concern, especially for fraud that occurs at the organizational level. But yeah, talking about corporate governance. Remember corporate governance? We talked a little bit about that. I'm going to allude a lot back to fraud in this class. So for those of you who are excited about it, great. And for those of you who are not excited about it, bear with me. But we talked about it back in 417. This idea of those charged with governance. At a very broad level, what does those charged with governance means? What does that mean? Who is the party that's generally charged with governance in a corporation? The board of directors, yes. Okay. The board of directors is going to be kind of the subset of the stakeholders that's charged with making sure there's oversight of what's happening. So there's those charged with governance. We did talk about a very specific area of corporate governance with respect to the audit, which we're going to we may allude to it a little bit in this class, but in general, it's going to be more focused on auditing rather than fraud. But what was that group of governance called that we focused on in auditing? The audit committee, yeah, the audit committee. So we already have some knowledge about corporate governance, but we haven't really defined corporate governance, at least not in our classes together. I'm assuming that you have some knowledge of corporate governance because you know a little bit about who entails corporate governance. So I said, we've talked about this before, but what is corporate governance? Okay, what is corporate governance? So I can think of no finer person to answer this than, let me look up who the name of the group is and leader is. Then Matt, yeah, I had you in mind all the time, Matt. I definitely was not just scrolling through my iPad trying to find the group name. Matt, what did you and your group define for corporate governance? What is it?
We said corporate governance is a system of laws and rules by which a corporation operates.
Okay, so yeah, that's kind of the first sentence of that, the first resource. So let's go ahead and talk about a couple of different perspectives on this. You all know me. I tend to be very, very verbose, but it's a whole bunch of little things that I like to put together, string together. I don't like long explanations. So we're going to talk about the short explanation, which is in the Fraud Examiner's Manual. Fraud Examiner Manual says it refers to a corporation's government, which is kind of silly because it's corporate governance, but broadly used to describe the oversight responsibilities of different parts of organizations' directions, operation, performance. Okay. That is a very simple definition, and I love it. Okay, that is a really great definition for kind of everything that we're about to talk about. But if we go to the first resource, it says corporate governance is a system of laws and rules by which a corporation or business entity operates. A set of processes, customs, policies, regulations, institutions, and a company or organization is directed and managed. It ensures accountability, organization, protects shareholders' rights. It also prevents fraud and corruption. It ensures the company's proper functioning. Now, to that degree, we talked about those charged with governance, and we said that the board of directors. But based on these definitions, can we say that corporate governance is limited just to the board of directors of an organization? This is not a question that I'm asking. This is just for opinion purposes. Could I make a legitimate argument that corporate governance goes beyond just the board of directors or the audit committee? Could I say that corporate governance, that management plays some role in corporate governance? I think that's a very relevant statement. At the very basic level, we could talk about what we talked about last week when we talked about the COSO framework. I said, no more COSO framework. Dr. Barnes, you promised. I said, no, I didn't promise. All right. But what's at the very top of the COSO framework? What is that component called? The control environment. Okay. Control environment is characterized by something called tone at the top. When you read through this paragraph, doesn't it sound a lot like the description of tone at the top when we talk about corporate governance? I thought so. I think that if we think about that perspective, it's the tone of the top, setting a clear direction for the organization with respect to practical operations and practical concerns, and making sure we understand the policies, the regulations, how the institute's effect over the corporation is organized and managed, directed and managed. So all of these things are kind of linear and related to one another in some shape or form. So obviously corporate governance itself is really important, but this is not a corporate governance class. This is not a class that's dedicated to the concept of corporate governance. So we need to talk about specifically what's going to be relevant to this particular course. So the first resource specifies some specific ways in which good governance practice can reduce the risk of fraud and corruption. What are the specific governance practices that were identified in the first resource? Okay, I'm a little bit more prepared this time. I don't know what it is. I'm picking 2 tax track students right away. If I had known that this was going to be the week for the brutal tax exam, I would have made the audit students the leaders. Okay, so Nina, I apologize for this, but I have confidence that you'll be able to prevail. So what is going to be the specific governance process we identified?
Clear written policies, checks and balances between the board of directors and CEO, conflicts of interest identification, internal controls with financial reporting procedures, regular audits, tracking reporting misconducts, accountable and transparent operations.
Very good, very good. That's generally what I had. I think I kind of alliterated a little bit more, but for the most part, yeah, consistent with what we identified. And so we can kind of use those as a very basic guideline for how we're going to set up corporate governance, and specifically how it relates to fraud risk or fraud and corruption. But yeah, so the general rule is that when we're talking about governance practices specify the direction of the organization, and that's going to relate to fraud and organization, because we know that there's a possibility that organization could be subject to that, whether that be at a minimal level, such as people stealing inventory from the organization, or at a macro level, such as a massive financial statement fraud. Governance practices are going to be important for actually detailing and curtailing that type of activity. All right. So as I said before, we're going to be back in undergraduate refresher. We're going to be talking a lot about auditing in this course. And some of you may say, we talk about auditing every week, Dr. Barnes. This is not a change. It's like, the question is, am I trying to force audit on you in every single scenario? And the answer is maybe. But this is not intentional. It's more about the direction of the particular topic that we're talking about today. So in a financial statement audit, what are management's responsibilities with respect to financial statements and internal controls? Okay. So the good news is that even if you're not an audit track student, this is going to be something that's relevant to you as you prepare for the CPA exam. But ironically, I asked an audit track student to answer this question. So Sydney, do you feel prepared for this one? Okay, so what did your group identify in this particular scenario?
Responsibility for financial statements to ensure there's reasonable assurance of their material statements, and then for internal controls to ensure that they're designed to monitor.
Right. So when we talk about financial statements, who's responsible for preparation and presentation of the financial statements? That's management. And we want to make sure that the management is doing the job sufficiently so that when the auditor comes in and tests those financial statements, that they are operating effectively. So yeah, I think you said reasonable assurance. That sounded like a testing. I know we were going with that. Okay.
I was talking about the auditor and just listening to it.
That's okay. I mix metaphors all the time. So yeah, so we're talking about preparation and presentation of financial statements. That's going to be responsibility of management, as well as, and you did specify this one correctly, design, implementation, and maintenance of internal controls. Okay. So the responsibility is on management to make sure all these things are up and working properly. So what is the auditor's responsibility? Kirsten, what did your group say in this one? So testing financial statements to ensure they're free from material misstatement. Okay, yeah, and then okay, so yeah, understanding of internal controls and usually testing internal controls to determine that they are both designed and operating effectively. Because keep in mind, if a control is designed correctly, but it's not operating correctly, then we might as well not have the control. So the design and operation of controls are both things that we have to consider within the context. So yeah, refresher back from undergraduate, but a really important one to remember. There's a separation in responsibilities between managers and auditors. And both of those have a relationship to fraud detection and prevention in an organization. So we need to make sure that both of those functions are operating properly and we have clear lines of responsibilities and know who's responsible for what. All right, so moving on to the group questions, so things that you identified here. So referring back to question two was kind of those listed out items, okay? First resources, he erroneously titles this section, Good Governance Will Detect Fraud and Corruption, all right? Which, as we know, controls can actually take two different forms. They can take forms of prevention or detection. And when I say detection, what I usually also include is detection. What is the other type of control that usually gets paired with that? Yeah, corrective control. Yeah, so detective and corrective controls, because it doesn't really make sense to detect a problem and then say, well, there's a problem. Bye. You know, so if you see a problem, you want to make sure you fix the problem as well. You know, that's kind of the goal there. So preventive controls are preventative, whichever you prefer, and then detective/corrective, but I only kind of specified detective. For each of the practices you identified in question two, specify whether the practice you identified is preventive or detective in nature. So I've kind of got some ones listed here. These may not align to what you identified, but I'm going to call you out and you can kind of specify what you think is the case. I think I identified 7, which again were roughly similar to the ones that Nina identified. I think we had a little bit of disparity, but even if you did identify the same ones, I have confidence in your ability to identify the difference between preventive and detective controls. Okay. So let's see, starting out with Olivia and back to tax track students. I'm sorry, guys, I really am. Okay, it's nothing personal. Olivia, so the first one, I do think this one was consistent, having clear written policies, procedures, and protocols. Would you say that's primarily preventive, detective, or both? Yes, that's preventive. Okay, I think that's one's clearly preventive and probably not detective at all. Okay. One that I think that I identified, but it was kind of it was consistent with what one Nina said, but a little bit on the outskirts. I think I identified this clearly outlining roles. Okay, so I don't know if you have that one listed, Brock, but I'm going to ask you for your speculation as a human being. Okay, if we clearly outline roles in an organization, would we say that that's going to be preventive or detective in nature? Yes, absolutely. Okay, because if we know what our responsibilities are, then we do our responsibilities correctly and we don't run into problems. Okay, good. All right, creating vigilant oversight. Okay, that was one of the ones that was identified in there. This one's a little bit more challenging here. Matt, what do you think? And again, if you have this as your group identifying this, then you can share what your group said. If you didn't, then you can shoot from the hip.
We said that it was preventative.
Okay, I would agree that it's preventative. I would say that there's probably also some detective mechanisms in place. So you may say, Dr. Barnes, that's not fair. We were going with one or the other. I didn't specify it had to be one or the other. It could be both. Okay. So this is going back to what we talked about. What is always the question for any accounting question that's ever been asked? It depends. Okay. And the answer to this one is it depends. So it could be preventative or detective. It depends on the certain situations. I would agree with Matt that I think primarily this is probably going to be preventive in nature or preventative in nature, each one, whichever prefer. Eliminating opportunities for abuse. Okay, so this one is a little bit more subtle and distinct, but we got to still talk about it. So, okay, I think Nina was up second. So, I don't know if that was one of the ones you listed. I think you had something close to that. What would your group say on that one?
I'm sorry, which one?
Eliminating opportunities for abuse.
Preventative.
Yes, that's going to be preventative pretty much in nature. So there's no opportunities, then there can't be problems. Okay, so that's going to be preventive. You guys are seeing a trend here. So good governance will detect fraud and corruption. What should probably that have been said at that section been titled? Good governance will prevent fraud and corruption, and maybe she'll occasionally detect it. Okay, that's kind of where we're going with here. So separating the roles of CEO and the chair of the board of directors. That was one that I identified. It's a little bit specific, but I'm going to run with it. So I think So Sydney's up. What would you say on that one, that specifically?
You said, both.
Okay. So yeah, separating the role of CEO and the chair of board of directors. Yeah, definitely there's going to be a preventive aspect to it. I think, again, you can make an argument that could be both on this one simply because if there's separation of responsibility, then there's not going to be any obscurement or impairment of the responsibilities. So there's not any chance for one individual to hide activity that's occurring that's maybe malfeasance. Ensuring robust internal controls and systems are in place. Okay. So I'm trying to remember everybody I talked to and I'm forgetting. Oh, Kirsten. Okay. Kirsten was up next. So Kirsten, what would you say on ensuring robust internal controls and systems are in place? Yeah, that one's pretty easy, both. Because again, this talking about the nature of controls being in place, and we know that controls can be both in preventive and protective. In fact, if you wanted to be snarky, you could even say, yeah, that would be 3, Dr. Barnes, because you forgot about the corrective. And that's correct. I did not include corrective in there, but that would be included in this one as well. All right, and then requiring accountability and transparency in operations. Okay, and I think this is Olivia's group back in there. So Olivia, what would you say on that one? Yes, I think I would agree with both. So requiring accountability and transparency in operations. Accountability, I think, would be more preventive in nature because if you have responsibility, then you have to fulfill that responsibility. Transparency, I think that would be more detective in nature because if people can see what's going on, then they can see if there's problems. Not say it's cleanly one category or the other, but that's kind of how I interpret it when looking at that. All right. So again, every single one had some sort of preventive mechanism. So what does this kind of tell us? Is that prevention is really, really important with respect to fraud. Okay. Again, we talked about the nature of deterrence and we talked about the nature of prevention, and prevention is kind of prevailed because deterrence is not really active. And detection is kind of an afterthought. If a fraud's already taken place, then you've kind of failed. So prevention, really, really important. All right. Question number 5, refer to the section titled Recommendations for Preventing Fraud and Corruption in the First Resources. What stakeholders are specifically identified as identifying corporate governance process? So Brock, I know you had a rough day because you had the tax exam. I gave you a pretty easy question here. Okay. So this is my gift to you. All right. Hey, what are the stakeholders that were identified?
Managers and board of directors.
So
you also have employees and shareholders and investors.
Yeah, so employees, managers, shareholders, investors. You include the board of directors. That's a subset of the shareholders, so that would be included in this there as well. All right, so and then this one's going to be a little bit less question, but you did such a good job at answering that question. I think I'm going to stick with you for this question. So, of the groups of which these groups, which one do you think has the most significant influence over corporate governance in general? And this one, unfortunately, does not have a clear answer. This is more of a subjective question. I think you could make arguments for multiple categories. But what does your group say?
Put managers, because they implement the policy and enforce the controls as separate culture, but more like the board of directors.
Yeah, so I think that there's an argument for both managers and board of directors. And so you'll notice here I didn't say which one is responsible for setting the policy with respect to corporate governance, but which one has more of an influence on corporate governance. And I think you nailed it when you said managers. I think you kind of said that even though they're not necessarily can be the corporate governance mechanism that we identify, they probably have the most impact on corporate governance, whether that be a good way or a good direction or bad direction. If you've got good management, then you're going to have strong corporate governance innately. If you've got bad management, then you're going to have a need for strong oversight. So the direction of management is going to necessitate the need for corporate governance. So yeah, I think that's probably an argument. Again, it's a little bit of a divisive argument. Some people in this room may say, that's not really a fair question, Dr. Barnes. It's not what you asked. And I said, yeah, it isn't. But if you perceive what I'm looking at here, what is the goal of corporate governance is kind of keep management in check. And if you keep it from that perspective, then I think that they have the most influence over corporate governance. But then I asked another question, which group do you think has the most significant influence over corporate governance as it relates to fraud? All right, Matt, we're back to you. Okay, so this one is probably a much more challenging one. But I'm interested to see what your group says. I'm probably gonna ask multiple group leaders on this one.
I think we read the question wrong and kind of answered wrongly, but I'll give you our answer. We said that it was employees because they're the most likely to give tips that result in a fraud being uncovered.
Well, I'm going to tell you something that's probably going to make your group cheer. That's exactly what I said. Yeah, yeah, I identified. So again, this is not saying which is responsible for implementing corporate governance policies, which has its most significant influence over corporate governance. And we know, based on everything we've looked at previously, that employees tend to be the more source of detection of fraud, and they're also going to be the direction of prevention of fraud. So I actually said the same thing. I said probably employees. Tracking and reporting misconduct, clear communication lines, those are all reasons that were given in corporate governance. So I kind of said that they had the most biggest influence. Not that they said that they were the ones responsible for implementing policy, but they actually were the clear direction for implementing fraud policy with respect to corporate governance. There are some very specific areas that were identified that relate specifically to employees. So yeah, I know you felt a little bit hesitant on that, but you nailed it. Good job. If I could give you extra points on your tax exam for that answer, I would, but unfortunately I don't have that power. But you don't need extra points. You aced it, right?
Yeah.
Okay. All right. So yeah, I think there's multiple arguments here. I don't think there's a clear path. I'm guessing that if I ask another group, they would probably have a different answer, or maybe they have the same answer. But regardless, there's multiple perspectives on this. I think the ultimate answer to this question is it takes all parties in order to have good governance over fraud. Because if one party says that they're not going to adhere to the protocols that are set in place for corporate governance over fraud, then basically there's no point in having the corporate governance in the first place. Okay. So strong corporate governance is going to kind of begin at the very basic level. It's going to be a foundation for the organization. All right. First resources stress the importance of clear communication lines for internal and stakeholders to better promote transparency and prevent fraud. Is it reasonable to assume that external parties would care about organizational fraud? Why or why not? All right. So another subjective question, though I think this is a pretty easy question. Nina, what'd your group say on this one?
We said yes. We think that external parties care about organizational fraud because if you're considering going into business with an organization, you don't want to go into a business with sketchy financials or like unstable internal controls. And if you're competing with an organization that is fraudulent, then it's just unfair.
Yeah. And so there's so many different perspectives. I think the answer is a clear yes, and you did a very good job of articulating that. Let's go a little bit more in depth in just kind of the nature of stakeholders in general. So would it be, if you're a large enough organization, would it be fair to say that your stakeholders is every single person on the planet? That seems really, it's like a responsibility. Like, but if I was doing like Apple or Amazon, could I say that they have stakeholders? Every person on the planet is a stakeholder of those companies. I know that's a stretch. You may say, well, maybe not everybody, Dr. Barnes, but you could make an argument, a large share, like especially the customers. So think about it this way. Think about a company like Enron. All right. So when Enron, when they had their fraud that it took place and they went bankrupt, did they have stakeholders that were outside of their immediate supply chain? So what happened to the market when Enron collapsed? The U.S. stock market. Anybody know? Can anybody guess what happened to the U.S. stock market? Okay. Yeah, I had a few people go like this, and that's exactly what correct. The stock market tanked. Even if you were not invested in Enron, did you suffer a penalty? Yes, because so we make arguments that people who were invested at that time suffered a penalty, even though they had no business in Enron. They may not have no business, no stake in Enron whatsoever. They were still a stakeholder. That's kind of a big responsibility to think about when we talk about large enough organizations. Now, if we're talking about small fraud, you may say, well, small fraud, that's not going to be something we consider perpetrating. But we already know that small fraud can escalate. Okay, something that we think is seemingly small can balloon to something seemingly large. We say misappropriation assets, not a big deal. It's really small in scope. I can remind you about, well, what about Susak David at Cost Corporation? What about Rita Crunwell over at Dixon, Illinois, stealing literally millions of dollars? Is it possible that we could have something like that in a large organization if they don't have strong controls? It may be not one individual, but you could have multiple individuals in the organization. Was Enron simply just falsifying financial statements? Was that the nature of their fraud? Do they have any misappropriation of assets of the company? I'm relying on the auditors for this one because we actually did Enron earlier this semester. Do we have any misappropriation of assets at Enron? A little bit going on, okay? So this could actually expand and balloon, and you could have stakeholders outside of your normal. So obviously, supply chain. Obviously, we're talking about people who are interested in the organization. Nina identified competitors because that actually has a double whammy right there. Think about it this way. So before the fraud is unraveled, they're competing on an unfair axis. You've got a company that's reporting information that's falsified, and so they look like they're more successful, which hurts your business model. What happens after the fraud is uncovered? then basically says, oh, your industry sucks because this one company was falsifying their financial statements. We don't trust anybody. So you get hurt by that too. So you get hurt on before the fraud takes place and after the fraud is uncovered. The company's hurt by it. So yeah, competitors are basically helpless in that particular scenario, which is kind of sad if you think about it, because that basically incentivizes all competitors to commit fraud too if a company's committing fraud. I'm not trying to say that that's what you should do in real life. Like, well, if everybody else is cheating, I should cheat too. Don't do that. Okay. That's not what I'm saying. Okay. I'm saying that it does create an unfair playing field where people operate and they're incentivized to do things they wouldn't do otherwise. So yeah, certainly problematic. Refer to the second resource under the section responsibilities for fraud and audit engagement. Which group has the primary responsibility for fraud prevention and detection? Sydney, what's your group say on this one?
We're on 7.
Yes, we're on 7.
The entities management.
That's right. That's right. So entities management has responsibility for prevention and detection, which makes sense because they're responsible. They're the ones who are responsible for the design, implementation, and maintenance of internal controls, which is going to be that form of security that relates a lot to that. Okay. Again, controls in context are going to be preventative and detective or corrective. By the way, what are controls trying to stop? Controls are a form of security, but they're trying to stop at a very general level misstatements within the organization, whether that be financial statements or just misstatements about operations in general. What forms can misstatements take? They can be intentional or unintentional. Unintentional misstatements are errors. What do we call intentional misstatements again? Fraud, okay, which is a big focus of this course. So it's important to note that there's an inextricable link between controls and fraud. So we understand that management having responsibility for controls has responsibility for primary oversight of fraud and prevention and detection. Which group has the primary responsibility for oversight? Okay, I think I used that term when I said the responsibility, but which is going to be the organization that kind of oversees management's work within this area? Kirsten, what'd your group say?
Those charged with governance.
Those charged with governance, which is higher level, the board of directors and the audit committee. Yeah, so board of directors in every publicly traded organization, most private organizations, and the audit committee. What does that tell you if you have a situation like Theranos? Okay, talking specifically to the audit students because that's what we're discussing. But like we talked about their board of directors, and their board of directors was a strong group of individuals, right? No, their board of directors was basically kind of a token organization that basically had no oversight, and it was all in the hands of Elizabeth Holmes. So if we kind of concern ourselves with that, if we say that there's no oversight of management responsibility, is there a higher proclivity for fraud in the organization? All right, what do you guys think based, because we're not, I know I'm mixing classes right now, and I apologize for that, but it's the first one that came to mind. Do we think that fraud may occur within Theranos? Yes, it's possibility. And so, Brock, I really appreciate your enthusiasm that, yeah, even though you're not in the class, you just kind of like really good. Yeah. Anyway, yeah. So, yeah. But although you could be familiar with Theranos and have heard about it, and you're just saying, Dr. Barnes, I'm very knowledgeable about this. And I said, no, okay, all right. I was giving you some credit there, but yeah. So Theranos certainly problematic in that, but with respect to how we actually review how we view responsibility, both are really important, because if you don't have oversight responsibility, then allows management to basically walk unchecked. All right, question 8. While the goal of financial statement audit does not specifically relate to detection of fraud, external auditors have responsibility to design procedures sufficient to detect fraud that has a direct and material effect on the financial statements. Under generally accepted auditing standards, what are the audit requirements with respect to fraud detection under a financial statement audit? And yeah, I should have left this for the auditors, but I'm going to call out some of the non-auditors since we're in that sequence. Olivia, what does your group say in this area?
And identify client-specific risks.
Yeah. So at a very general level, if we're talking about generally accepted auditing standards, there was really kind of just a very limited, series of responsibilities. It was kind of listed out here. Okay, so maintain professional skepticism, and a part of that basically want to have engagement team discussions about how material misstatement may occur during the fraud, and make sure that we want to document it during the brainstorm session. So we've talked about the brainstorming session. That's something that occurs at the beginning of every audit, where the audit team gets together and says, what are the possibilities for fraud and how can we actually address those possibilities? So that's really, really important. But this idea of professional skepticism, really important. Don't take anything at face value. Always question everything, even in this course, because I have definitely said some things that are wrong in the past. Nothing in this course, obviously, but in the past, yeah. All right. So bigger question, what are auditors' responsibilities with respect to risk assessment under AUC section 315? And there's probably a lot going on here, but Brock, what does your group say with respect to this one?
Auditors must inquire with management about fraud risk assessment. They should inquire about any unusual transactions or unexpected relationships or knowledge of suspected frauds. Evaluate and assess any suspected risk. Assess risk of material misstatement due to fraud and document how fraud risk assessment is.
Okay, so there's a lot going on here and a lot of these bullet points, and you can just kind of copy and paste these down and that would be consistent. But let's just go ahead and break these down into a kind of some specific categories. First of all, make inquiries with respect to fraud risk or significant unusual transactions. You want to talk to people and understand what is the nature of fraud within the organization, and is there any unusual activity that might take place in the organization? Now, what is the goal of that particular step? What is the goal of that step? To gain an understanding of how fraud may take place in an organization. Brainstorming is all good and well, but if you're not familiar with the organization's operations, your brainstorming capacity is going to have limitations. All right. Then we're going to evaluate those unusual unexpected relationships, specifically those during analytical procedures. Remember, analytical procedures, we can develop a model and we can say, or we can develop trend analysis or ratio analysis and say, this looks weird, okay? Gross profit percentage was 20% all the way up until this year, and now it's 35%. I don't understand how that can happen. So doing something like that can evaluate, can do that, help our evaluation. Want to make sure that we evaluate indications of fraud risk factors, okay? They were the only company in their business area for 20 years, and then all of a sudden they got two competitors that are much larger than they are. Is that going to indicate a pressure that might incentivize them to commit fraud? Yeah, that's kind of what we see time and time again. Companies that struggle in their businesses, they're more likely to commit fraud simply because of the threat of new entrants into their industry. That might be an example of one of those new fraud risk factors that might come up. Risk of material misstatement due to fraud, and then document and respond and document appropriately. So basically, once we understand what are the nature of the risks, we want to make sure that we documented those and we have those clearly in mind so we can approach those as we're addressing the areas of fraud. So yeah, that was a challenging question. You did a good job on that one. So according to the second resource, there always exists a chance that an external auditor may fail to detect a material misstatement in a client's financial statements despite having obtained sufficient appropriate audit evidence. That goes back to that reasonable assurance thing we talked about way back in 417. Do you think that intentional misstatements are generally easier or more difficult for an external auditor to detect than unintentional misstatements? Boy, that is a question that is a loaded question right there. That is a loaded question right there. Matt, do you think that's an unfair question?
I do.
Oh, you
We
do?
still have an answer.
Yeah, you still have to answer for it. Okay, all right. I'm waiting to hear what is the answer.
We said it was more difficult just because usually fraud is covered up and a misstatement is just a mistake and it usually doesn't have any documentation to cover it up.
Right. Now, so yeah, it's definitely going to be more difficult because there's an intentional incentive by a fraudster to make sure that their fraud is not found. That's really kind of to the point. If you commit a fraud and expect to be caught, then what's the point of committing the fraud? So the nature of fraud by itself, it has an expectation of we need to do stuff to make sure that this fraud does not get caught. Now, there is a counterpoint to that. If we know that people are going to try to disguise their fraud, then we can treat the preventative and detective measures for the frauds a lot more seriously than we would for preventative and detective measures for unintentional misstatements. Because especially if we're concerned that unintentional misstatements may happen and we can't do anything about it, there's not really any point in trying to promote controls in that area. But if we're talking about intentional misstatements where we know this is going to happen and we know that there's a risk of it, then we can take that more seriously. So yes, there's efforts in both directions and they kind of parallel each other. Even though the fraudsters may try harder, the auditors can try harder as well. So that's kind of the answer to that. So that's kind of one of those questions. It's basically like those arguments that get us this. So I know what you're thinking. Says, well, I know you know what I'm thinking. Well, I know you know that I know what you're thinking, and that could go on forever and ever. Whoever actually has the most patience is going to win that argument, and hopefully that's going to be the auditors in this particular scenario. So, final question: which group do you feel has the most overall influence in fraud prevention and deterrence in an organization? Those charged with governance, management, external auditors, or some other group? And defend your answer. Nina, we're going to wrap up with what your group said on this particular question. What did your group say on this one?
We said that we thought that those charged with governance, because they're the ones that put procedures and regulations in place and they have to ensure that those measures are being enforced.
Yeah.
The right.
Yeah, and I was a little bit suspect on this. I said management, but I think the argument that we made is exactly the same. Because keep in mind that the whole goal of this is to basically establish a strong control environment for an organization to operate, both with respect to just general misstatements and misstatements related to fraud. And who are the parties that are going to be responsible for establishing that? Those are going to be those charged with governance as well as management. So both parties are going to be responsible, which is not fair because then I would say which parties, not which party. I did have you pick out one. It really would depend on who you think has the most impact on that area. And so, again, it was a bit of a tricky question, but I think that the ultimate conclusion is not which party. The ultimate answer is not which party it is, but why these different parties have an impact on the control environment in the organization. All right, and with that, we're moving on to quiz time. All right, let's have at it, guys.
So we did our presentation over Bernie Madoff's Ponzi scheme.
So for a quick summary, the scheme started in 1991. He was a successful broker investment for like 30 years before this, but the scheme started in 1991. Like the quiz said, the investment promised high returns with low risk, 12 to 13%, which is unheard of, which is another big one of those, big red flag. Needed new investors to sustain profits to pay out the old debt. 2008, the economic struggle caused the shortage of investors, so no new investors were investing in this Ponzi scheme.
So it resulted in $50 billion in losses for investors. It went on for about 17 years, and the SEC throughout that time wasn't able to detect it. He eventually confessed to his sons in 2008 that everything was going to kind of start falling apart. And then he was sentenced in 2009 to 150 years in prison.
So our first key party is obviously Bernard Madoff himself. He was born in 1938, and so he was roughly 50 when he decided to start this whole thing. No, he was known as the Monster of Wall Street. It was the largest Ponzi scheme known for history. He started his career just with a penny stock brokerage, which then grew into his investment security company. And he employed a lot of his family, but then confessed to his sons that it was just one big lie as it was falling apart.
So our last key party is investors. Madoff's firm offered what most investors seek, a low risk and high returns. This is kind of why all the investors were drawn to him. They accepted offers that should have been a red flag. There's a lot of scenarios where they should have steered away from this company. No other investment firms could even match or come close to what Madoff's investments were. And then he was said to generate healthy returns, but were actually paid out from the funds bought in by new investors. So not actually real investments.
That's it.
I accidentally did view only. Is it okay like this, or should I go on my computer and get you? Okay, sounds good. So we also have Madoff Securities. So for the fraud triangle, some opportunities, like the group one said, the investment was just too good to be true. And so investors just like blindly believed him without like truly knowing how he was getting his returns. And there was also weak oversight. He employed a lot of his family, and like due to like what he claimed, the what generated returns was like really convoluted. And so it was really hard for a lot of people to understand like how he was like making his money when it was all just a fraud. And some pressures. Once you start a Ponzi scheme, it's really hard to get out because the pressure of like giving high returns consistently, just builds and builds. And he was also like his reputation, like he was seen as a financial genius and was like pretty famous in Wall Street.
And so for rationalization, he was just like, it's temporary, we'll be able to get that out of this, like the market will change and we'll be able to rise above, but the scheme lasted for over 17 years, so why not just continue? Why just not push it a little further? And then he believed that he could eventually recover his losses, and so he just kept digging himself deeper into that hole.
So lesson to learn, just remain ethical. He had a long career on Wall Street, and from everything I see, he was doing just fine. So there was really no need to cross this ethical boundary and create a Ponzi scheme. But once you cross that line of ethicalness, it's hard to go back. Then encourage transparency. Not really the best in this case because he was the one not being transparent. There was no one that could enforce him to do that. But in other companies, you could. Then for investors, if an investment seems too good to be true, it probably is. What I like to do, I like to know what company I'm invested in, what they actually do, how they make money, instead of just throwing my money at different things. And then we need to audit the auditors because their auditor, Freeling and Horowitz, did fraudulent audits every single year.
There's an interesting point about transparency in the Madoff scheme is that Madoff Securities actually had two lines of business. One of these was actually legitimate business ventures, like legitimate investments. The ones that generated the really high returns, and the ones that were just had no transparency whatsoever. He did not provide electronic disclosure of the financial information. Did not provide any electronic statements. You couldn't actually access your account electronically. It was just a paper statement every single time. And in this day and age, that should be a signal that there's a problem right there. So relating back to what we talked about with transparency, that should be kind of a common theme, especially with kind of our financial statement frauds, that a lack of transparency is a really, really big problem. Yeah, apparently I've been signed out, I need to sign back in. Somebody's gonna pay for this. Who's gonna pay for it? Sydney. All right. All right.
For ours, we did the case, it's cheaper to let them burn, so yeah.
Hold on. I gotta go back. Did you just put like superimpose a picture of a mother and a daughter together on the
I
car?
wanted to install shop.
So, well, the original slideshow was like mom and me.
It was
and
like a
so
Mother's Day slide.
Oh,
And so, but we thought the it was like burnt, you know, and so that was more, that's why we picked it, but it was currently or originally Mother's Day.
I mean, you've got to push the promotion as well as possible, you know.
Yes, using all our resources. So first the parties, so we have our villain for the senior management. We don't like his face, so we're gonna cover it up. I don't like his face. There was a memo where they discussed whether it was cost beneficial to install a feature in a car to save lives, because obviously you have to do a cost analysis if you should save lives or not. And then we have our heroes, who is Mother Jones, and that's a not-for-profit magazine company, and they released the memo. And then we have the NHTSA, which is like the National Highway Traffic Safety Agency, and they investigated the problem for 4 years.
Oh,
Yes,
love.
we love them.
Okay, so now into the memo. Like Sydney said, it was like a cost benefit analysis. So in this memo, they said that there was like an expected cost to like fix the cars of like $121 million, and they got that from about $11 million in sales, and then an $11 modification cost. And then looking at the cost of lawsuits, they had an expected total cost of just about 50 million, and they calculated this between $200 for the like 180 deaths they expected, and then 67,000 for the 180 serious injuries, and then 700 for the 2,100 burned out vehicles.
And then so they decided to just produce the car with no safety modifications. And so what was going on with the car is like once it was rear-ended, it was alleged that the doors would slam shut and then the gas tank would explode. So that was really problematic. It was eventually, or like there were some recalls with the car, and so they installed safety kits to help prevent sharp objects from whenever it would explode to help like dull them. But yeah.
So the results from them deciding to go with the cheaper option of just pulling off the lawsuits, basically in the like automobile industry during this time frame, like the cause of deaths from like car specific fires was like nearly 9,000 people. This wasn't just specific to Ford, but the fact that Ford kind of hid their safety precautions could have brought light to like safety in general and prevented a lot of other automobile companies from having maybe similar features, yeah, problems of their company. So like Dennis said, there was recall. And then this meant that there should be standards, and we did some brief research. It didn't look like any of Ford management went to jail, unfortunately for this. So I think I tried to look into it. Apparently confirmed 27 people at least died and maybe 500 to 900 like injuries specific just to Ford. So yeah, pretty bad.
Yeah, and it was called the barbecue that seats four, so.
Quality or quantity? People die. Traffic. There she is. Yeah, every single time.
Okay, we had the other side of it.
So some of the pressures that Ford faced was their competition with other automakers. They were wanting to kind of rush this car to sale, wanted to kind of stay ahead of the curve. So with that being said, they had a 25-month deadline that they were trying to meet. Of course, rushing that caused them not to implement the safety features that they needed to. They also had pressures to meet profits from other people within the organization.
And then they kind of already went over it, but the rationalization, they mapped out the cost of both recalling and putting in the safety features, and then the lawsuits potentially that they would have to deal with, and decided that the lawsuits were less expensive than recalling and actually doing the work. And they also were like, well, the cars have safety issues too, so if they're not doing it, why would I? And then opportunity, they had the ability to ignore safety risks. There weren't a lot of regulations, and something like this is not the easiest to pin back on board, especially back then. So they had the opportunity and wanted to save the money, and were tight with competition. So they decided it was their best bet.
So then going to the lessons learned, they said value human life, it's priceless, and be ethical. Don't talk over memos, talk in person. And you shouldn't use non-financial information for all cost analysis. And then I said at the bottom, if you're gonna be dumb, you gotta be tough, aka take the consequences. Okay, that's it.
So real quick question before we start our next presentation. Given the time frame this took place, was this a fraud? I've included as you're saying, well, it's in a fraud examination, Dr. Barnes. It's obviously a fraud. Was this a fraud? I don't know that we can actually categorize it a fraud when it took place, because this is the early 70s when the regulations, what they did was perfectly legal and completely unethical. Would we consider this to be a fraud today in this day and age? Probably so, probably so. I don't know. This is one of those ones that I was reading through and I was saying, I'm going to throw a little bit of monkey wrench in here, because I don't know if we can quantify this as a fraud, but I do think it has fraudulent aspects. Hence the reason we had a fraud triangle up there. So, all right, group 5.
Fresh,
Oh.
escaping refresh.
Okay.
Oh.
Oh, guys,
Okay. So we had the EY fraud. So the main parties involved, he's not really like as involved, but he was in charge of the investigation, like department at SEC, like enforcement. And so he's the one who was like kind of giving statements after this was all being discovered and such. He's got Dottie in his hand. Touch Dottie, sorry.
The other key party that was involved, obviously EY and mainly their. So kind of the summary, I don't really know if it's in order, but like EY through whistleblowers kind of found out that they had some cheating going on the ethics portion. And they didn't really do anything about it. And then the SEC heard about it and they're like, okay, now we're really gonna look into you because like you didn't do anything about it. So they found out about it and they got like $100 million fine. And the punishment was punitive to like set an example, because like other firms might have been doing it too, but they wanted to like set a standard, like no more cheating on the. And then, yeah, so it was on the ethics exam, but it was also on CPE courses for the practicing people as well.
So they were caught due to a combination of two things really. First was just bad OPSEC. You know, if you're gonna commit a crime, you probably shouldn't go telling people that you committed a crime. That's generally not gonna be well for you. So they were kind of doing that, and so because they were telling each other that they were committing crimes, some internal whistleblowers sort of stepped in and reported it to the SEC, but again, or reported to EY. But nothing happened immediately. It did take the SEC step in. Yeah. In terms of penalties, they were fined $100 million. They were forced to undertake some excessive remedial measures to fix the ethical concerns. They have to retain 2 separate independent consultants. One of them is going to review the firm's policies and procedures, and the other is going to review their disclosure failures, whether or not any employees contributed to the hampering of the investigation. And this was only 3 years ago, so those independent consultants are likely still working with the company. Thank you.
I had to go defend myself.
All right, we also did Ernst & Young ethics exam for our presentation.
That was a broad question.
Just all fit together very well. So we got the fraud triangle. We all know about the fraud triangle. Well, if the employees, or in this case, the whole company, has pressure to create fraud, sees an opportunity to create fraud, and can rationalize themselves to create fraud. Well, let me tell you, we're in for a big warning. All right, going into it. We'll start with the pressure. Sorry, blocking the meme. I'll go over here. We see that auditing is a high stakes environment. So there's a lot of pressure to keep your credentials as a CPA. And it's a very competitive workplace culture. All the big fours are competing against each other, creates a lot of pressure. The company could have been thinking more about long-term employment and not wanting to rehire and retrain, because that costs a lot of money and they don't want to lose money. And firm just needs to keep producing qualified CPAs, which is a lot of pressure. For opportunity, well, there was very weak controls and very little monitoring, and nobody was reporting it. Like, everybody saw that people were doing this, nobody was reporting it. So if nobody's gonna report it, might as well do it. And then they also had access to the test materials, so if you have the opportunity to cheat and it's right there, I wouldn't do it. And then they also saw that their company was willing to withhold information from the SEC, so they didn't think they could get penalized.
Yeah, so I have to explain why I did the crime, guys. So my rationalizations were, I already passed the hardest part, so the final step was just a checkbox. And due to I'm already working at UI and there's a lot of clients I have to get to, so I had to misplace my priorities and cheat on exam when impact my auditing skills. I know what to do is right. This test not gonna determine my character, and then also everyone else is doing it in the firm, so why don't I just do it too? And lastly, the firm's unethical tone at the top kind of convinced me to commit the cheating too.
And then for lessons learned, so for an individual, if you're going to cheat on an exam, please do it on anything except an ethics exam. I mean, don't cheat at all, but if you've got to pick, please avoid the ethics exam. And if you're an organization and you've discovered evidence of fraud, don't hide it from the SEC. That's just gonna make it worse. And in general, accounting firms really do have to meet a high standard for ethical behavior because, their work is the foundation for financial statements, which are important for conducting business. Meeting this standard should be a top priority for companies. And external oversight and having an ethical corporate culture are both really important.
But group one, in addition to, or sorry, group five, in addition to accusing several of their classmates of fraud, they made a point of saying that the SEC actually issued this fine as a deterrent. How likely do we think that the deterrent, I mean, in the short term, it's probably going to be effective. How likely do we think that it's going to be a deterrent in the long term? Probably not. We've been talking about deterrence a lot this past 3 weeks, and my opinion about deterrence is you form a cost benefit analysis similar to like the Ford Pinto, and you make a determination that the cost of committing a fraud is lower than the cost of committing fraud is lower than the benefits of committing the fraud. Cost is less than benefits. I was right the first time. Then you're going to be incentivized to do so. And ethics is a really, really hard sell, especially when it appears that we got people who are willing to cheat on something that is ethics based. So yeah, I do think that this will come up again. I will say that my own experiences with these CPA courses, especially the ones that are training courses that were at the Big Four based, it's really hard to take those seriously because they are kind of just time sucks. They're basically saying we've got to do this because we got to, and when you're in the middle of a client work, like, so imagine you're studying for a tax exam that's coming up, a really big tax exam, and your forensics professor is saying, hey, I want you to make slides for the next presentation. It's like, well, I've got the serious work and then I've got the clown work on the side, so I'm going to put the clown work and not take that seriously because I've got the really important work that I'm going to do. It's a little bit like that in an audit environment. It's like I've got my client work, which is the important stuff, and I've got this training, which is really irrelevant. It doesn't really test my skills as an auditor. So it's really, really hard to justify something like that. That's where rationalization of activities like that becomes pretty easy. All right. See you all next week.